Welcome to Forexia, and thank you guys for tuning in. Today we are going to be talking about trading M and W formations. If you would like to get more information, check out forexia.net or check out our Telegram, telegram.me/forexia. If you would like to join in on our group chat, go to Forex Community .online. Type it in the browser right up there, and it'll direct you right to our group chat. So let's get started with this. Trading M's and W's. Today we're going to be focusing on the 15-minute time frame. We're using basically a naked chart. We have the 800 moving average here, exponential moving average, EMA, I call it a few different things. 800, the blue is the 50, and the white is the 200. So basically what we are going to be doing is, first of all, looking at the time scales, the session breaks, so we can see basically the days. And here we are on the pair odd USD. We can go on any pair, but I'm just gonna use this as an example because it has a big fat W M right here. And how could we have traded this M that's right here? Basically, M's and W's form off of the highs and the lows, right? They form off of the highs and the lows of the week, the month, the day. Even on the minute chart, there's M's and W's on the highs and the lows. But for our purpose, we're going to be focusing on the 15-minute chart and looking at the highs and the lows of the day and the highs and the lows of the week, and sometimes the highs and the lows of the month. But right now, just stay along and we'll focus on the 15-minute chart right here. We can see the high of the week was formed 3 days ago, almost 4 days ago. Here's Sunday, the gap, the beginning of the week. They came up. The dealers came up. Notice, alright, I didn't plan anything ahead for you guys. I don't have any script, but I'm just gonna play along, go day by day here, through this whole week, the whole 1, 2, 3, 4, 5 days, starting with Sunday here. The opening, you can see the W formation on the 200 moving average. So M's and W's that form on moving averages are they have a higher potential of playing out the way you want them to. So here we can see a W you could have bought right there at the second leg, or right here, could have bought there. And if we're using TDI, we can also see there was some divergence. And the divergence basically helps us understand when price is lying to us. Like, there will be some times where price looks like it's going down, but yet on the TDI, the indicator says it's going up. So it's helpful to see when price is lying to us in this type of circumstance. So we could have taken that trade up $70 pips or so, or even closed it out at the end of the day here at 30 pips, because we're trading intraday on these M's and W's. Most of them are going to be trading. We're going to be trading intraday, but there will be some, like this big fat one right here, that we would trade on a longer time period, or as a swing trade. So, gosh, I hate this update with TradingView. It's crazy. I don't know why they did that. So we could have rolled this up 30 to 70 pips. We can see price hit a high right here. It made the high of the week, and then it came off of that. And then we can see right here, this is where we would have bought. We would have tried to buy at the hit of that second leg. Or if we would have seen a wick come up and go past that second leg, we could have bought at the wick. But it didn't go past or I should say the first leg. The second leg barely touched the first leg. So it barely touched the high of the week. But you have to remember the spread on the brokers is what determines the orders in here, the pendings that are being hit. So you always have to take that into account. You always have to remember that there are times when the broker can open the spread, and this is when he'll do it. Like the spread can be fine through here, but there'll be that hit to the high, and he can open the spread on you and grab all the pending orders above the high of the week. And this is why the M&W is so effective. I'll show you on like a drawing here. Okay, so we're trading these M's and W's, right? Why? What is this? Basically, what we see is the dealer making a high here, and then what the retail traders see is this. Retail traders see this. They see that trend is going to keep moving because they follow a trend. Retail traders are always following a trend, you guys. And sometimes it's good, but you have to realize when an M and W is being made, you have to realize where they're trapping and how the trend might be reversed. So this is what goes on. They make that high. Okay, the market makers make the high, and then all the retail traders put their trend lines here, right? And then they start putting buy stops above that trend line to catch the trend as it breaks. And this is what the market makers do. They'll break that up, grab the buy orders, and stay up there for a little bit, like you can see happen right here. They'll stay up there for a little bit, sometimes, and then they'll change the trend. But you can see it's the same concept. It's the same thing that's going on. The second leg of the M will fake the retail traders out and trap them above the high. And if you can catch the second leg of the M or W when it forms, there's something called a shift in the zone. where the dealer shifts the price away from retail traders. What am I looking for? My goodness. There we go. Okay, so basically, when the M or W forms, there will be a shift, a sharp shift right here where the dealer stayed up above that high for long enough and trapped enough retail traders above that high that he shifts the zone, and you instantly go into profit if you catch that second leg and you catch that shift in the zone. That's what we're trying to do. That's what we're trying to trying to trade. Okay, so we can see right here's a perfect example. Here's the beginning of the day. Here's the end of the day. Okay, market makers or the dealer came down and he created the first leg of the W off of the low of the day. Okay, we can see there was a previous low right here, right? And then the dealer came off of that low, broke that low, and then created the new low and did not break it, but opened the spread just enough to catch the pendings in here. So you can see the W, open the spread, catch the pendings, and then here's the shift in the zone where they instantly shift and then they move the trend. They change the trend to the opposite direction. You can see it happens on a macro and a micro. Okay, you can also see right here is a little M. I mean, they're everywhere, you guys. This is so simple once you get to have a understanding of the variations of how these M and W's play out. So here's an M. They formed off of the high of the day here. Here's the high of the day. You can see market makers made that M. Here's the second leg. Here's that star pattern or star formation. The evening star, morning star. I don't know what they call it, but that's the confirmation that we use. That second leg. You could go in right there as a sell and catch that downtrend. An easy 30 to 50 pips. But you can see it playing out all the time. Here you can see it again. This is just a really weird variation of the same thing. Okay, the dealer opened the market at a certain point right here. That was the high of the day. They came down, they filled the gap completely. Upon filling the gap, they managed to get a bunch of liquidity from that gap and move price back up and make that big fat M you see right there. You could have gotten in at the shift of the zone right here where you can see the railroad tracks, or you could have dared to get in at the very tip right there. But you can see the same thing. We can write it down 20 to 30 pips or more. You can see the bigger the M or the bigger the W, the larger the shift in the trend will be, the larger the change in the trend. So if you caught the second leg right there, you would have been able to grab at least 100 to 150 pips. And this is all we're trading, you guys. This is all we're trading, these M's and W's. Second leg, M and W. You do not have to trade anything else. And the tools that we use are just tools, okay? You do not trade because you see just divergence on something that's not an M or a W or something like that. You don't add your own retail trading aspects. You don't add your own, try to like change something to make it work. I don't know. You don't have to change anything with this. Okay, you can see here is a big M. You can see divergence on the TDI. Complete change. Okay, and remember how I showed you this. This is what a retail trader thinks will happen. Look it. Doesn't it look like that's going to happen? Okay? It looks exactly like that's going to happen. It looks like the high has been blown out and now you can buy. Okay, right? That's the retail trader mentality. The high here was blown out and they closed above the high. Okay? Let's all buy. And look what happened. Boom. A shift in the trend. They completely shift the other way. And they don't even let you out. They do not go past that high. Okay? You could have caught that, grabbed 200 pips. Okay? I'm not saying we're going for that many pips. I'm saying catch every M and W you can. Okay? Catch every one that you can. Here's a W. Right here, you can see divergence. Perfect example. The market maker broke the low, but did our candlestick pattern. They broke the low and then shifted right back above the low again. And then changed their direction, changed the trend. So you can also see the divergence in TDI right here. So, are you guys understanding a little bit more? I really hope so. Here's a big fat M. We can see it off of the high. This is what we're trading. Second leg M or W. You could have caught it right there. Another characteristic of the M and W is the second leg 75% of the time will be more fierce, more powerful, or more have more momentum. I don't know how to describe it in a retail trader term, but yeah, it'll have more momentum to the upside, and it'll just remember the dealer's goal is to fake as many people in the wrong direction as possible. So if you think it's going down, he has to make you think it's going up. It's going to continue that uptrend. He has to make you think it's going to do that when really it's not. So how he does this is creating that big spike, the big, what you think is momentum, what a retail trader thinks is momentum. And you can see right there, they trap as many people as they can on that buy, and then they totally destroy them. You can see it happens here. Again, the big fat W. And another thing to point out is when a W or M is made above or below all 3 EMAs, it is a reset in the original trend. So here we can see the market is basically downtrending, and then price comes down, makes the W below all the EMAs, and then comes up again. So it resets the uptrend. It comes down, resets the uptrend, and then comes up. And then they do this, they keep resetting the trend until they have built enough momentum to basically completely shift the zone from here to here. And it happens really fast. You can see they did it, market makers did it twice. They made a W below all 3 right here, and then they did it right here one more time. They made that W formation off of all the EMAs, but price was below all the EMAs. So that is a very that is the characteristic of a reset in the trend. So we can see they reset the trend not once but twice before shifting and moving up, resetting the uptrend. So let's go on to a different pair just to show you guys it happens on all pairs. I'm not lying or something. I didn't set this up. Let's just go on like a really weird pair. We can see it happening all the time. And if you've watched our other videos, you can see this this pattern happening all the time as well. It is basically the dealer's daily pattern. But here you can see the M formation right on top there, the divergence. Could have caught that right there as a sell. We can see it happen again right here. The M off of the high of the day. You can see it happen here. The W off of the low of the day. And this is all we're doing, you guys. This is all we're doing. Price goes up. And this works on every pair because it's the same concept. You're not dealing with different you're dealing with different commodities or currencies, but the concept behind it all is the same thing. It's all made because of the mentality that was instilled in retail traders since the beginning. It's what we've been taught. Okay? Here is the big fat M right there. You could have caught it there, or you could have caught the bigger M right here. Like I've said before, it happens on a micro and a macro scale. So we can go in the 4-hour time frame, and we can see the same things happening all the time. We can see the high of the week or month, and then there's the M that they formed off of the high. Here it is again, the high. They created that M. You sell right there. Boom. It's everywhere. On every pair. Okay. Let's get back to our main screen. I want to thank you guys for watching. Sincerely thank you guys. Hope you learned a lot about trading M's and W's, and yeah, I really did not expect the video to get this long, but I am glad I was able to spill a bunch of information for you guys, and hope you learned something. So thank you guys. If you enjoyed the video, give it a thumbs up, subscribe, share it with your friends. Peace out.